Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita, and let's get you up to speed. We've got an hour to go in the trading day, getting ready to close out the week, and you're still looking at a mixed picture here for the major averages. Now, we're not too far from the flat line. Investors now having some time to digest the August jobs report that we got before the bell this morning, and the report showing that the labor market is slowing just a bit. Unemployment rising to 3.8%, the highest level that we've seen in more than a year. But as you can see with the Dow now up just around 80 points, we're well off the highs of the session. The Dow was up just over 250 points earlier in the trading day. Taking a look at the sector action for today, energy by far the leader in today's trading day. Oil closing up just around 2%, the highest close that we've seen for crude so far this year. But again, for the day, we're looking at a mixed picture. For the week, though, all three of the major averages on track to close to the upside. All right, well, Wall Street digesting the latest jobs report, which shows that the labor market is slowing. Unemployment jumping in August, unemployment rate, I should say, jumping in August, up 0.3% to 3.8%. It's the highest level that we've seen since February. Wage gains also moderating, a sign inflationary pressures are easing. Hiring remains steady with 187,000 jobs added. Traders and are betting that the Fed is more likely to hold rates steady. Markets pricing in a 93% chance that the Fed will pause at its meeting later this month. For more on the labor market and what it means for the economy, we want to bring in Neela Richardson, ADP chief economist. Neela, it's good to see you here. So certainly it looks like, at least when you take a look at that unemployment number, rising 0.3%, 3.8%, the labor market is slowing. Is it slowing enough, though, for the Fed?
I think that rate is really interesting to watch because it could be slowing, but for the right reasons for the Fed, which is more people are coming into the labor market. We've gone from 3.5%, which is a historically rock bottom rate, to a slightly higher 3.8%, but still below 4% on the basis of more people joining the workforce. So good news in terms of labor force participation that also went up, and that is a great number to watch in terms of a Fed who's worried about tight labor markets. There's a sense that those markets are loosening, which means not quite as strong wage growth, which will not likely be more at risk of driving inflation. So from the Fed's perspective, I think this is along the road of what they would like to see.
Yeah, labor force participation up for the first time since March of this year. We're looking specifically at increases from older workers as well as prime working age women. What's driving that?
You know, that was a trend that was going on before the pandemic. Women's workforce participation was high, and there was this ongoing trend of people 65 and older staying in the workforce longer. And that's really, really important when you have an aging population that is growing faster than your workforce population. That growth in of itself is inflationary. So the fact that this trend is getting back to normal or getting back to pre-pandemic levels with women participating in the workforce after being harder hit by the pandemic and older workers rejoining the workforce is good news for a lot of reasons.
Neela, what does all this mean for a recession or lack thereof? Because most of the base case here going into this report was the fact that we would be able to navigate the soft landing. Is that still intact?
I think it is. I mean, the transition period from going from super strong growth to slower, more typical growth can be jarring. And you can't fall asleep on these numbers. The move from 3.5 to 3.8, it's still a very low unemployment rate, but it's a pretty sharp increase in 1 month. And so it's really a number to watch as we go into the fall. If that number is going to continue to climb, that's going to tell us a lot of what we need to know in terms of whether we can achieve a soft or hard landing. But if you match this labor market data with very resilient indicators coming from the consumer side, it doesn't look like we're heading into a recession anytime soon.
How do you think we should be looking at the lag effects? I mean, we've been talking so much about the lag effects of monetary policy, the fact that we have really just started to see some of that take hold. Is the economy strong enough to withstand some of that?
You know, as strong as this labor market is, it's highly fragmented. And you've seen those effects already take hold in manufacturing, which is an interest rate sensitive sector. There was barely any gains in manufacturing this month. And at ADP, we've been tracking manufacturing and we've seen some weakness all year. So though this is a solid job market, it's also a highly fragmented one. I think you're seeing the effects of Fed policy, but only in pockets where whether it hits overall, it will depend on where that terminal rate ends and how long the Fed keeps rates at higher levels. Right now, because of all the stimulus that was part of the pandemic recovery, it's taking longer. So the Fed policy is even more lagged than normal.
Neela, where do you see that terminal rate ending?
You know, that's a great question. I think the Fed's job is harder now than it was when inflation was higher. Ironically, when inflation was at 9 and 8%, there was really only one direction to go, which was to hike rates. Now that we're getting inflation that is much lower, but still about double the rate on core that the Fed would like to see, their decision point is much trickier now. It wouldn't be surprising to me if there was one more rate hike. It wouldn't be surprising to me also if they pause, but a pause shouldn't mean a stop. Or doesn't necessarily imply a stop. They could pause just for a month like they did back in June and then decide to raise rates again. So I think it's very tricky for the Fed over the next few months.
Neela, it's been a very busy summer in terms of activity coming through from labor unions. And in this jobs report, we saw the actor strike subtracted roughly 17,000 jobs from payrolls in the industry. You've got another potential strike on the horizon, looking at UAW negotiations, that September 14th deadline. How big of a risk does a worker stoppage in that industry present when you think about the overall picture we're looking at right now?
You know, strikes are bad for inflation. What you want to see is that you have a productive workforce, and strikes are a disruption in that productivity. What you hope is that at the end of this collective bargaining process, there is an agreement that works for both parties involved so that they can continue into the business of writing scripts and building cars, because ultimately that's good for the economy. But overall, I think it's another point of that fragmentation I pointed to earlier, this time from a different source, but very important to keep track of.
We will be closely watching that. All right, Neela Richardson, ADP Chief Economist. Thanks.
Thanks. Have a great weekend.
You too.
Well, Bitcoin and other crypto assets under pressure today after the Securities and Exchange Commission delayed its decision on spot Bitcoin ETF applications. Jared Blickery is on the floor of the New York Stock Exchange, tracking that for us and much more. Jared.
This just shows you how much we have to do on a summer Friday afternoon before Labor Day. These are filings that were largely expected. The SEC decided to postpone or deny the application. That rolls them over into another date. It's mid-October for the next decision. But these regard a spot Bitcoin ETF, kind of the holy grail right now for Bitcoin lovers and Bitcoin bulls. It was only a couple days ago that we had that decision. I don't know that it was a surprise, but it was a decision in the Grayscale versus SEC case where they were suing to allow GBTC, that's a Grayscale Bitcoin Trust, to convert to a spot Bitcoin ETF. That was approved, and so that could eventually go through, but that's going through in a different way because that has to do with the court system. Now, all of this actually started a few months ago in the middle of June. June 15th was the day that BlackRock originally filed this application for its spot Bitcoin ETF. There was so much enthusiasm based on that we actually saw a huge multi-day rise in Bitcoin. There were a couple other things going on at the same time, but everybody else who was going to file a spot Bitcoin ETF, they jumped on the bandwagon within the next couple of days, and we saw Bitcoin go from 25,000 to 30,000 and just above. But given some of the disappointments that we've seen recently, we've seen that fall off quite a bit. I said earlier in the week, right before the big Grayscale decision came out, we probably don't have another big catalyst until something changes materially with the Federal Reserve or we get to the halvening next year, and that has to do with the finite money supply of Bitcoin. So another story indeed. Getting back to the main point, we're at about 25,000. 25,000 gives. There's not a lot of weight, or there's not a lot of support under that until you get to about 21,000. So we could definitely go lower, but none of this really means that much in terms of price action between $20 and $33,000 anyway. It's not until we push materially above, let's say 35, 40,000, that we can say we are out of the woods and probably emerging from the Bitcoin spring into the Bitcoin summer. Notice that I believe we have already emerged from the Bitcoin winter. So enough on crypto there. I don't know if we're going to get any big decisions or anything else that will move the market next week. Not maybe CPI, but that kind of brings me back to today. I said the Federal Reserve, if it changed interest rate policy, that's going to affect all risk assets, not just Bitcoin. And what we saw this morning was a rise in yields. I don't think this morning's report changes the game for the Federal Reserve. If anything, it takes some pressure off of them. But with regard to risk assets, summer is over. We know that we're entering September, October. That's when portfolio managers finally rejigger their portfolios from over the summer when they're dealing with that low liquidity. So any number of things can happen over the coming weeks and months. Finally, I would add, I just remind everybody, September, worst month of the year going back to 1950. Yes, however, when you filter for a couple other variables, like the market being strong through July and falling off in August, we actually have pretty good results throughout the end of the year. So I think a little bit of caution is warranted. Not too much of expectations is warranted with regard to Bitcoin, and ceteris paribus for everything else.
Yeah, important for a lot of investors to kind of take a deep breath going into the long weekend and bracing for September. Jared, thanks so much for that. Well, we are just getting started here on Yahoo Finance Live. Coming up, a sudden departure. Walgreens CEO Roz Brewer stepping down after less than 3 years on the job. We're going to explore what the change-up means for the company. And a pricing dispute between Charter and Disney causing a blackout of ESPN and ABC channels for Spectrum cable subscribers during Thursday's college football kickoff. All the details on that fumble coming up. And prices at the pump. We're going to get a read on the cost of gasoline heading into the holiday weekend. All that and much more when Yahoo Finance returns.
Outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for.
Really the big issue here, two big issues. One, private companies in the sector, smaller companies, mid-sized businesses are being much more squeezed than their public counterparties. And the leverage position of companies is going to be the big story over the next 6 months, but really the next probably 24.
Spending is down, and that's going to put back to school shopping at risk, and back to school shopping is a bellwether of what's ahead for Christmas and holiday shopping.
We've seen a significant uptick in organized retail crime, and it's certainly impacting the profits of organizations. So we need to educate folks on what organized retail crime actually is. And these are individuals and groups going into stores, stealing massive amounts of quantities of merchandise in various stores day in and day out.
These smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones that have a better chance of turning things around.
The consumer continues to be concerned about inflation. Promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend.
Comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. And in an environment where consumers are stretched and just trying to cover the essentials, Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus.
I'm in agreement. Trend that we've been seeing a lot with Walmart is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers. And that in return is turning into loyalty consumers that are now extending themselves.
The consumer this year has been much more cautious, looking for deals, looking to trade down, looking to buy lower priced items within category, and to buy smaller baskets.
2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner.
The future of retail is media, and the future of media is retail. I think as you look to the future, like a year from now, you're going to start seeing that these retailers are driving content shoppable experiences.
China's central bank is taking additional steps to bolster a weakening economy and currency today. The PBOC announcing it will cut the foreign exchange reserve requirement ratio for financial institutions from 6 to 4%. The central bank also moved to cut down payments for homebuyers and called on lenders to lower rates for existing mortgages to stimulate a slowing real estate sector. The policy moves come as foreign investors increasingly move money away from the world's second largest economy. For more on China's economy, let's bring in Brendan Ahern, Crane Shares CIO. Brendan, as I talk about this, I'm seeing a healthy pop, at least in your ETF, KWEB, but there's a headline that caught our attention yesterday in the FT that pointed to $12 billion in outflows from foreign investors in Chinese stocks, a record. How much of that is warranted when you consider the state of the economy in China today?
Yeah, certainly this is one of the largest outflow months ever in the case of foreign ownership of Chinese A shares, stocks listed on the Shanghai and Shenzhen exchange. The number is large as it was. If you step back and look at the inflows over the last 5 years, it's over $200 billion. So the general trend of foreign ownership is still quite high. If anything, it also shows that maybe foreign investors are very poor market timers because this outflow is occurring just as Chinese equities are enjoying one of their strongest weeks in quite some time.
But Brendan, what about so much concern, though, about the economy right now, the slowdown that we're seeing, the fact that it doesn't seem like investors are confident in what they're seeing play out in China? So what needs to change? How do you improve investor sentiment when it comes to investment opportunities there?
Well, investor sentiment is very, very low at this point. I think in general, across institutional investors that we've been speaking to globally, you have a significant overweight to U.S. equities versus non-U.S. equities. That's driven just by significant outperformance of U.S. equities over the last 14 years. But I think more specific to China, you're seeing, I think the key is that some of the issues that have really been headwinds for investors in the space, things like the Holding Foreign Companies Accountable Act, Zero COVID, U.S.-China diplomatic relationships, real estate, China's internet regulation. You take all of these issues, it's really led the asset class almost to be eviscerated. And I think what's happening is you're seeing a pivot from the Chinese government. And you're seeing a number of these issues, things get less bad, or just simply they are improving. And I just think investors' ownership is very misaligned for some of these issues to actually recede, to improve, or at a minimum get less bad. So we're actually constructive from a contrarian perspective for that reason.
So what does that investment case look like?
Well, certainly the Chinese government is literally telling investors to buy their stock market, that they've cut a lot of the fees associated with holding Chinese equities. They've limited the number of IPOs, because the IPOs represent more supply. At the same time, they've tried to promote the underlying companies to issue dividends and to buy back their stocks. So I think the government is very aware that the economy has had a very tepid recovery, and you're seeing these significant changes. You're cutting the mortgage rate for existing mortgages. That puts, it's estimated about 12,000 RMB back in the pockets of Chinese households. At the same time, they've cut the bank deposit rate, which means they don't want to see that money go back into bank accounts. They want to see it get spent. So you're seeing this pivot from the Chinese government to try to stimulate domestic demand. And that's where we're very constructive, specifically within China, on the domestic consumption sector.
So, Brendan, when you're identifying opportunities like that, I guess more specifically, where are you seeing opportunity? And when it comes to that negativity, how much of that do you think is already priced into some of these names?
Oh, I mean, I think these companies, I mean, you take all 31 companies in KWeb, and they generate more revenue than Amazon or Alphabet. And yet for Amazon's market cap, you could buy all 31 companies in KWeb and you'd have 200 billion left over. In the case of Alphabet, you could buy every company in KWeb and you'd have $500 billion of cash left over. So again, it just shows that a number of these issues have really pushed investors out of the asset class. And specific to where we like, I mean, it's self-serving and highly biased. As a shareholder in KWeb personally, we love the e-commerce space very simply because we believe that this push to domestic consumption, something that we've actually seen in the EV space and in the home appliance space earlier this year. We think they'll apply much broader policies to try to raise that domestic consumption. And with 25% of all retail sales happening through the e-commerce companies, we think that's a particular area of focus for investors going forward.
Brendan, you mentioned a number of moves that have been done by the PBOC as well as the Chinese government to try and stimulate the economy. It just hasn't been on the scale of what we saw, of course, back in 2008, and then more recently in pouring investments into the real estate sector that is at the heart of the problem right now. What are some additional measures you think the government is likely to take, and to what extent is that going to be effective when you consider the reality of the debt that exists? I mean, we're talking about 4% growth being the norm now.
Yeah, I mean, certainly the real estate, it's a two-faceted issue. One is you have distressed real estate developers like Evergrande, Country Gardens, Sunac, and there's several of them. And that problem isn't going to simply resolve. There is no silver bullet, but they're going to allow those companies to muddle through. They're not going to allow them to create a financial crisis. There's such an emphasis from the Chinese regulators on the real estate sector that they're trying to prevent, a proverbial first domino from setting off a chain reaction. The other issue on real estate is 2/3 of urban Chinese household wealth is in real estate. So as real estate prices fell for the first time ever, it's weighed on consumption trends because Chinese households saw part of their balance sheet decline in asset values. So I think they're very much, there's a huge emphasis on real estate, and it's not going to resolve itself. We should expect continued issues, but it's getting a lot of attention from the government.
Okay, we will continue to watch it. Brendan, good to talk to you on this Friday. Brendan Ahern, Crane Shares CIO, joining us there.
We are looking at shares of Tesla falling today into the red, off just around 5.5%. More price cuts and also worry over competition in China is weighing on the stock. The EV giant cutting the price of its Model S and Model X in the U.S. and also in China. Tesla is also unveiling its revamped Model 3. It's now on sale in China, but with a steeper than expected price tag, starting around the equivalent of $35,800. And Kiko, this is just a continuation of what we've seen play out now over the last several months. We heard this warning from Elon Musk most recently in their last earnings call, saying that more price cuts may be necessary. We're seeing the fact that demand, obviously a concern here for Tesla, for its competitors, as we talk about the fact that people simply are pulling back on their spending. They don't have the excess cash to go out there, have as much money to buy an EV. So here we are again with Tesla changing the price of its Model S and Model X for the 7th time this year.
Yeah, I mean, it's worth separating the two stories, I think, Shauna, because when you think about what's happening with the Model X, that price cut was made right to come within that cap of the IRA. So that car is, in fact, eligible for the federal subsidies, which makes it a little more affordable, although it's higher than the Model 3 and the Model Y. So that's largely seen as the big motivation behind the cuts there. The Model 3, though, is probably a bigger concern when you consider the Model 3 and Model Y make up such a big chunk of the revenue and deliveries for Tesla. And a lot of investors were expecting that new Model 3 coming out to be at a lower price point, to be able to compete with the BYDs, with the other cars, especially in China, where the competition has been so steep. So that's a big concern for China. Worth noting, though, I mean, Tesla doesn't change a lot of models or churn out a lot of models. This is the first time they've churned out an update on a model since the update on the Model S a few years ago. The Model Y, of course, in 2020 was the first real sort of rollout of a new model that we have seen in some time. So it is getting a lot of attention, but disappointment here in terms of the pricing for that car, even though the range is pretty incredible when you stack it up against some of the other Chinese EV makers.
Yeah, it certainly is. But at least for Tesla's move today, we're seeing a negative reaction off just over 5%. All right, let's talk about another stock that's on the move. Roz Brewer out as Walgreens CEO after less than 3 years on the job. The stock sliding to a 14-year low. Anjali Kamlani is here with the details. Anj, we're looking at a loss of 7%.
That's right. And of course, the loss of CEO Roz Brewer just coming weeks after they lost their CFO, James Kehoe. So it's really two top spots at the company now vacant with searches to fill. Now, Roz Brewer didn't really give any indication. This comes a little bit as a surprise to many, but Evercore ISI analysts did say that the timing, while could be a surprise, does seem to fit with what Walgreens is moving into, which is their healthcare segment growth as a vertical, and may make more sense for someone who has that healthcare experience to be in the top spot, or at least the top two as a team, as the company moves away from being just a retail pharmacy giant. If you know Roz's background, we know that she has been in retail for quite a number of years with Walmart and Starbucks. So, it does make sense to move. But there really was no indication in a LinkedIn post just the day before. Roz was talking about having a leadership meeting and saying, quote, "Our new fiscal year begins Friday, and I'm excited for what's to come." So no indication there that she was thinking about leaving. At least on that note. So definitely comes as a surprise. We've seen Walgreens struggle with returning to what was a focus in 2019, pre-pandemic, if you remember those days, which was, front of store sales, getting more prescriptions filled. And so that remains a concern now for the company as its COVID windfall wanes, which we've seen for other pharmacies as well. But if you compare it to, say, competitor CVS, they've also pivoted to being more of a healthcare services company. So definitely a shift in what we know as modern day retail giants.
And Anjali, another big shakeup, at least we're seeing in the health space. Amazon's One Medical facing a CEO transition. What's happening there?
That's right. So Amir Jane Rubin, who had been a part of the, the company's not founding, but since 2017 had been with the healthcare startup, saw its transition through the Amazon deal, 3.9 billion there, just stepping down, or at least announcing that he's going to step down later this year. That doesn't come as too much of a surprise if you've seen what's happened with CEOs of companies that Amazon has acquired. If you take a look back, PillPack, for example, the founders there, as well as Ring and Twitch, those two founders also leaving, just months after the deal last year, I believe, is when all these happened. So you see that transition happening, even though at the time of the acquisitions, the note did say they'd be staying on. So definitely another sort of shakeup, if you will. But, Amazon continues to follow this healthcare path and continues to grow One Medical right now with many hospital deals and more in-person services. So definitely interesting to see who they pick to fill a spot, if at all.
Well, all right, Anjali, thank you. Well, coming up, sports interrupted a dispute between Charter and Disney, causing a blackout of ESPN and other channels for millions of people. We've got more on this after the break.
Shares of Disney falling today after the media giant pulled its TV channels, including ESPN and ABC, from Charter's cable system Spectrum after the two companies failed to reach an agreement over contract fees. Yahoo Finance's Alexander Cannell joins us now with more. And how does this get resolved, Ali?
That's a big question, Akiko, and it's pretty significant, this back and forth. And just for some background here, Charter, which has nearly 15 million subscribers and is the second largest cable provider in the U.S., they were airing the U.S. Open, one of the first college football games of the season, Utah versus Florida, and all of a sudden, right in the middle of that action, that was pulled. So a lot of angry sports fans there. And the conflict, it stems from Charter alleging that Disney has insisted on higher rates and limited flexibility, arguing that its proposal will lead to, quote, unsustainable price hikes for consumers and would force users to pay for channels they might not want or can't even afford. Charter said it actually proposed an alternative model in order to create better value for consumers, but that Disney rejected it and then subsequently pulled those channels, which does not only include ESPN, also the Disney Channel, Freeform, National Geographic, as well as local news stations on the ABC network. Now, in response, Disney, which we just got this response about 20 minutes ago, said Charter refused to enter into a new agreement that reflects market-based terms, writing in part, contrary to their claims, we have offered Charter the most favorable terms on rates, distribution, packaging, advertising, and more. So again, a lot of back and forth, but it's worth noting that these issues surrounding carriage fees, otherwise known as the fees that pay TV providers pay to networks in order to carry those channels, they've mounted in recent years, especially as we've seen linear TV viewership decline, more folks moving over to streaming platforms. And amid that phenomenon, we've heard from analysts that say linear TV is essentially dead at this point. So for Charter, the stakes couldn't be higher. They don't want to lose any more subscribers, but the stakes are also high for Disney. This is a company that has seen its stock struggle significantly. There's a lot of other challenges. They're bleeding money on the streaming side. So there's just this push and pull here. Ultimately, we heard from Tim Nolan, an analyst that said he thinks the issue will be resolved because the stakes are high for both sides, but TBD when that will be. And we're seeing other entertainment companies like Paramount Global, Warner Brothers Discovery being dragged down with their share prices as well on the heels of this news.
And Allie, this is just the latest trouble here for Disney, right? We've been talking for a while now about the trouble that it faces with the Hollywood strike. Obviously, has had an impact on the company there. But when it comes to the Hollywood strike, we actually started to see it reflected in this most recent jobs report that we got out this morning. What did we see there?
Yeah, for the first time, we're finally seeing the impact that the strike is having on job numbers. And according to the Bureau of Labor Statistics, employment in motion picture and sound recording industries decreased by 17,000, reflecting strike activity. As we know, the writer strike, it's about to enter its 5th month. It will soon be month 2 for the actors on the picket lines. And there's currently no end in sight after studio negotiations hit a stalemate last week. So likely even more job losses ahead. And we've also been hearing about the economic hit as well. Kevin Clouden, he's chief global strategist at the Milken Institute. He was on Yahoo Finance Live earlier this week, and he upped his projection to $5 billion. That will be the hit to the U.S. economy. That's up from the prior $4 billion as we see more movie delays, as we see more TV cancellations, and primarily as we see lost wages. So this story surrounding the strikes, it also leads to the stories that we're hearing about the economy and the jobs and what we're seeing in the labor market. So it's all connected, all related. We'll have to keep tracking this the longer it goes on.
Allie Cannell with the roundup there. Thanks so much for that.
Well, markets, they're still mixed here after the August jobs report signals some cooling in the labor market. You're looking at the Dow up just over 100 points. The S&P holding on to gains is coming after the unemployment rate ticked up to 3.8%, the highest level that we've seen in more than a year. Well, stocks regaining some of their momentum today, at least for the S&P and the Dow, after the S&P logged its worst month since February in August. Year to date, though, the index is still up big, climbing about 17%. Here to break it all down, we want to bring in Jeff Bierman, TheoTrade Chief Market Technician. Jeff, it's good to see you here. So let's start with the jobs print that we got this morning, the reaction that we're seeing in equities today, and what it signals. What do you think?
Listen, Sean, it was already factored into the data. The market was already ready for a dovish, or what I call a Goldilocks number, not too hot, not too cold. And so you see the market trading flat today, spiked up on the news, settles in, already priced in. So it doesn't surprise me that the market's tracked nowhere on the first day of the month with this type of print. Now, had we delivered a hot number, it may have been a different story, but it came in as expected. So it could have been just a buy on the quick pop, sell on news, and kind of settle in here. So again, nothing surprising.
You know, to kind of follow up on what we were talking about at the top of the show, you know, how much of the market is actually reading some of the lag factors that could come in when you think about where the economy is headed. Yes, we are starting to see the slowdown. Yes, the expectation is the Fed is likely to hold the rates going into year end, but there's still a lot of uncertainty about what current existing monetary policy will likely mean in the next several quarters. Do you think there's a bit of complacency that's kicked in?
No, I think there's a tremendous amount of complacency that's kicked in, Akiko. As a matter of fact, I call this the sweet charity market, like from the 1967 film. And there's a song in there that says, "Hey, big spender." Now, I listened to your piece before where you said, hey, look, spending has come in a little bit on some of the high ticket items like Tesla, some of the things like NEO. There's also been a sort of a slowdown in spending in travel, in terms of airlines, in terms of lodging, things like Marriott, Hilton, Airbnb. They've all come in about 15 to 20%. And so I can see some of the big ticket items have come in terms of travel services and what I call a status. But one thing has not slowed down, Akiko, is the spending in what I call technology or in designer brands whatsoever. You're looking at stocks, TJ Maxx, Abercrombie and Fitch, Lululemon, these high status kind of companies, brand designers, they just never tick down. People continue to spend regardless of the actual rate hikes that have occurred. I'm not sure exactly why, but at some point, consumers are going to have to look at their credit card balances and think to themselves, well, if I don't pay off at the end of the month, what might be the ramifications? And their balances are going to build. And the other side of this is the lowest savings rate in the United States in over 40 years. We're down at about 2.5 to 3%. So everybody's pretty much tapped out on his or her credit cards. So although spending has been curbed in some areas, it's not been curbed in all areas. And with the low savings rate, to me, it spells some type of like corrective mode that's going to take place if we cannot maintain jobs at a certain high level. So expect the job number to slow down, expect spending to slow down. It's just not being reflected in the market just yet. Give it time.
So Jeff, what could then be reflected when we talk about the chance of a possible correction? What does that correction look like?
I don't think it's going to be that serious of a correction, just a demonizing thing. However, let me put this in perspective, Shauna. This is the greatest bifurcation that I've ever seen in 35 years between value stocks and growth stocks. Portfolio managers are treating growth stocks literally like they're the ugly redheaded stepchild or cancer. They want to have nothing to do with it. As a matter of fact, the lower the value stocks go, the higher the growth stocks go. The market is sending a message that we don't want value at any cost. We don't. We want growth at any cost. And if you were to ask me what the linchpin is that's going to get the market to turn on its heels and finally get that corrective mode, it's probably going to be somewhere between the mean reversion of the growth stocks coming down and value stocks becoming back into favor. That's where I see the market start to do its kind of corrective mode. And I sent you a graphic that there are two sectors that carry the market this year. If you remove there's 11 sectors in the S&P, technology and consumer discretionary are responsible for the entire gain in the S&P. Absent of those two sectors, the S&P is actually down for the year. So at some point, the consumer discretionary sector, the XLY, is going to have to make a move. And the XLY is made up of things, like I said, high-end, the Lululemons, the Nikes, the Abercrombie and Fitches. Those things are going to have to correct at some point, and value at some point will come back into play. For some apparent reason, dividends have no interest to portfolio managers. I'm not sure why. Yeah. But in a corrective mode, that would seem the place to park your money.
So Jeff, is all that to say that you see opportunity in value right now, and that's where maybe investors should be looking?
Oh my goodness, do I see opportunity? They've been shunning utilities all year long. Nobody wants to touch utility because interest rates have been rising. But the fact of the matter, AT&T and Verizon actually offer tremendous yields. Their cash flow is steady. And if the market does go into a corrective phase, this could be a place to park your money to get a lot of upside, as well as a very kind of juicy dividend. My other two areas is they've been shunning, except for Eli Lilly, Akiko, all year long, all year. Nobody wants to have anything to do with pharma. Pfizer, kicked to the curb. Bristol Myers, kicked to the curb. Those are the places where the greatest value opportunities are because they're at single-digit PEs and yields that go from 3 to 6%. So I think that if the recession siren is sounded, you're going to find great value in pharma and in utilities. And that money will actually come out of the XLY and come out of the XLK because it's just been overcooked for too long.
So some opportunity in some of those recent beaten down plays. Jeff Bierman, always great to get your perspective. Thanks. Have a good weekend.
Thank you, Sean. Have a nice day.
Well, coming up, prices at the pump. Find out how much you are going to pay to fill your tank this holiday weekend and into the fall. We've got that for you after the break.
Americans gearing up for the long holiday weekend. And for those looking to hit the road this Labor Day, gas prices are expected to be virtually identical to last year. That's at least according to Gas Buddy. Our next guest says there may be an unexpected surge ahead. Here to discuss is Patrick DeHaan, Gas Buddy, head of petroleum analysis. Patrick, I feel like you're always outside enjoying the weather, but let's talk about what crude inventories are pointing to right now. When you say there's a surge ahead, what's likely to drive that?
Well, I think a lot of it is the unknown hurricane season. We saw another big weekly drop in U.S. crude oil inventories, falling over 10 million barrels a day. So while gas prices have kind of eased up after rising for 7 straight weeks, we've seen a little bit of relief. But now with crude oil prices marching back to $85 a barrel, hurricane season coupled with those depleting inventories are more crucial. We're not out of the woods yet. There's areas of interest out in the Atlantic. Obviously, Hurricane Idalia came and went, no impact from that, but there's still a lot of time left in the peak of hurricane season, and that's what could cause a late season or early fall bump at the pump that could still be pretty noticeable.
How big of a bump could we be looking at?
Well, you know, with low oil inventories and with hurricane season and with the Saudis expected to extend the production cut into October, we still could see oil prices hit $90 per barrel. And it's possible that if we get the perfect storm, average gas prices still could get close to $4 a gallon. Now, there is some relief in mid-September that arrives with the changeover back to cheaper winter gasoline. By mid-September, the odds of hitting $4 certainly decline, but there's still a couple weeks between now and then. And like I said, a very active Atlantic hurricane season underway.
So that's the look ahead. As it currently stands right now, what does that demand look like going into the long holiday weekend? I know last time we spoke, you said that while demand was up, you're still seeing a significant pullback when you compare it to years past, partly because of the transition we have seen to EVs.
Yeah, that's right. Demand has been a little bit softer this year, of course, with the broader market slowdown and inflation numbers going up. People aren't feeling as great about hitting the road. A road trip now entails an expensive hotel. Restaurants that have gotten more expensive. So demand this summer has been relatively soft compared to last year, even with lower prices. Now, so far on Labor Day weekend, we're anticipating gasoline demand will rally for the holiday to about 9.2 million barrels a day. That would probably put it behind July 4, but ahead of Memorial Day in terms of travel. And after Labor Day is over, of course, gasoline demand set to decline. Most schools are reopened now. And that's going to mean likely downward pressure on prices after the holiday weekend is over.
Patrick, when we talk about some of the factors, we talk about the fact we cannot predict, obviously, hurricanes, what exactly the hurricane season is going to look like this time around. But when we also factor in some of those geopolitical factors, there has also been a massive push here to drill more in the U.S. How do you see that shaking out just in terms of supply and supply being able to meet some of that demand?
Well, as you mentioned, U.S. oil production has continued to rally. It's continued its COVID recovery. We're at 12.8 million barrels a day in the latest weekly supply estimates from the Energy Information Administration. That's just under where we were prior to COVID. In 2024, we should continue to see slow yet modest improvements. And that's helping offset, at least partially offset, the Saudi production cuts, which have continued. That plus China's economic weakness has given us a little bit of breathing room. But again, if we get a hurricane, if inventories continue to contract, we are still just on the cusp of oil inventories that are at relatively low levels. So that's been a wild card we'll have to continue to watch.
And Patrick, when you consider where we're at right now, the national average, $3.81 a gallon, at least according to AAA. What are we looking at into year end? Well above $4?
Well, again, I think the only way we get to $4 a gallon is a major hurricane that disrupts refineries or some other extreme event. I think barring a hurricane, I think we'll probably segue into lower prices. We could see the national average falling 25 to 50 cents by the end of the year if everything goes right. And if there's no unexpected additional production cuts from OPEC. So there's a lot of what ifs, but generally speaking, the fall is the time that we see falling gas prices, especially after that transition back to cheaper winter gasoline, which for much of the nation starts on September 16th.
Patrick, is that going to be the case for all parts, consistent here throughout the country? And I guess, what are you seeing on a regional basis?
Well, at least for now, it hasn't been so regional. That is, the West Coast has been experiencing gas prices increasing ahead of Labor Day. That's a trend that could continue. The West has had a lot of refinery challenges in California and Arizona. There have been pipeline and refinery issues as well. In fact, a waiver issued because of a couple of Texas refineries that have struggled. But for much of the east of the Rockies area, I do expect moderation to happen over the weeks ahead as they transition back to winter gasoline. So a bit of a split ball, and a lot of it really has to do with refineries. So keep in mind, if there's any hurricanes, that's going to really impact much of the country because much of the nation's largest or most significant refining capacity is down in the Gulf Coast.
Gas buddies, Patrick DeHaan, always appreciate you joining us. Enjoy the long holiday weekend.
You as well. Thanks.
Well, coming up, we are counting down to the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned.
I'm Brian Sazia, Yahoo Finance here, and there is no Labor Day ice-cold brewskis for me. No tomahawk steaks, no hot dogs, no burgers, no coleslaw, no nothing, because I'm getting ready to fly out to the Goldman Sachs Communicopia Tech Conference. Big name there, but that is because it is a very big conference. A couple things we'll be talking about at this conference: AI, and big deals. And to bring all those things to life, we have a lot of big guests on tap all week, live on Yahoo Finance. I'm missing my Labor Day to go out and report from this conference for 3 days. I suggest you tune in.
Walgreens shares under pressure today, off just about 7% after its CEO Roz Brewer is out at the company. Now the board has appointed Ginger Graham as the interim CEO, but Roz Brewer leaving the company after just over 2 years in the job. We know it has certainly been a rough year for Walgreens. The stock under a tremendous amount of pressure, off over 30% year to date. But Akiko, when you take a look at the reaction that we're seeing in the stock today, analysts saying that this move is going to bring on some anxiety here from investors, talking about the fact that not only the CEO, but also the CFO announced that he was stepping down just over a month ago. So two of the top jobs there, we're seeing some changes, and that, at least in the short term, could add some volatility here.
Yeah, March 2021 is when Roz Brewer took over as CEO. So to your point, a very short stint here. And Walgreens shares down 50% when you look at where things have gone over the last 2 years. I mean, this comes at a time of incredible transition for this company. You know, a lot of people think Walgreens and pharmacies and the retail stores, well, they've been trying to move increasingly towards healthcare services. In the company just sort of not seeing her is sort of the right fit as they make this transition. But it'll be interesting to see how things pan out. When you think about the background of Roz Brewer coming through from Walmart as well as Starbucks, she had a strong retail background, but she is the one that kind of pushed for this push to these services or healthcare services. Investors certainly not seeing that as a positive because of all the uncertainty that's happening within the company. The stock down more than 7% today. Well, Dell surging after exceeding Wall Street estimates, the company issuing an upbeat outlook as it rides the tailwind of the AI boom. Yes, we are talking about artificial intelligence again, Shauna, right now, as it relates to Dell. The potential growth here and building out the servers is what investors are betting on. But it's also about a rebound that's happening in the PC business, because that has really, really struggled and weighed down for Dell.
It certainly has, but when you take a look at some of the enthusiasm, the jump that we're seeing today, Kiko, is the best day that this company has had since it returned to the public markets about 5 years ago. So it's certainly a continuation of what we've seen since the start of the year with AI, the hype surrounding that, Dell being one of the companies that's actually proving that maybe it could see, or it is seeing in some analysts' eyes, a real payoff here from the investments, from the demand for AI servers. Morgan Stanley coming out naming Dell its top pick in IT hardware, replacing Apple here, citing that improving demand. We also know that the company raised its full year guidance. So Dell shares having quite a day and closing up just over 21%. And that was a closing bell on Wall Street. So let's check in where the major averages closed for the day. You're looking at the Dow and the S&P both in the green, with the Dow up just around over 100 points here. S&P also in the green. The Nasdaq closing to the downside here, just below the flat line. Another mover, Disney, closing the day. It's been under pressure here, off just about 2.5% amid its dispute with Charter Communications over distribution fees. Now, Disney blocking its cable channels, including ESPN and ABC, from Charter. We saw some of this concern ripple throughout the media industry. Some of these companies, Disney far from the only one, Fox also being among them, under pressure as a result of this today, Akiko.
Yeah, I mean, Charter TV saying essentially that this model that exists right now in terms of cable TV, just too expensive. And this is something that we talked about, Shauna, about, you know, how consumption habits are changing in such a significant way right now, where that leaves those like Charter and their cable outlet Spectrum in terms of just how big of a cycle that is. I mean, where do viewers go in the face of so many streaming services on top of that? In many ways, the cable TV bundle feels a little more affordable given how many outlets there are today.
Yeah, certainly. It's going to be interesting to see what this does to prices here going forward. We were getting some analyst reaction. KeyBank was really saying that this really highlights the risk across the sector, and that's why we saw so many of those names under pressure today. We talk about the fact that Disney losing some of its negotiating power, what this signals for other companies here going forward, and the fact that consumers have so many more options. They're opting to pay for the streaming services instead of cable. So the risk here that this could eventually increase some of the cable cutting that we've seen. But Disney closing off just around 2.5%. Charter Communications also in the red on the day, off just over 3%. Well, the housing market facing a freeze as three key factors keep buyers on the sidelines. Mortgage rates above 7%, low inventory, and rising prices. Just this week, pending home sales are down 14%. Now that's a 14% decline from a year ago. Joining us now, we want to bring in Glenn Kelman. He's the CEO of Redfin. So Glenn, the big question is what is this cooling effect? How big of a cooling effect is this going to have on the housing market? What do you think?
Well, rates have been high all year. They peaked in August. They seem to be easing slightly now. So I don't think sales volume could go any lower. And prices are actually headed up because inventory is down. So I think the market is in a holding pattern, waiting for a break from the Federal Reserve.
As are so many other sectors, Glenn. It's been interesting to see how home buyers as well as builders have tried to work around the rates as well as inventory levels. We have seen an incredible buildup in new construction, new homes. You've talked, though, about this generational shift that is happening right now as a result of lack of affordability, as well as just the lack of opportunity to buy homes. I wonder if you can touch on that, because, we sort of talk about homes day in and day out, but what is this long-term shift that we're seeing as a result of where we are today?
Well, it's decline in the American dream, isn't it? At this point, 30 years ago in their life cycle, baby boomers own more than 20% of U.S. national wealth, whereas millennials own less than 10%. And it's simply because millennials can't afford a home. We pulled the ladder up just as millennials were coming of home buying age. Home prices shot through the roof, then rates shot through the roof. And now there's so many people who want to move and can't. There is still unfinished business in this country where people want to leave the coastal cities for less affordable parts of the country, but those for more affordable parts of the country. But now the more affordable parts become less affordable too. And so really, it's just a case of arrested development where people who want to move can't. And it's a tragedy.
So then, Glenn, how does this play out?
Well, you just see lower household formation, more people living with mom and dad, shacking up with roommates instead of striking out on their own. It's one reason why family formation is down. People aren't getting married as much. They aren't starting families and having children because they just don't have the living space to do this. And so I think that housing is a basic human need. We are going to see more people looking for homes. The real issue is inventory. There are so many folks who want to move up who aren't putting their homes on the market because they can't even afford the place they have now. Interest rates have gone up so much. They are loath to leave behind that 3% mortgage rate. And so the real crimp in the industry isn't actually demand, it's supply. There's not much of either, but there's especially low supply with new listings down more than 10% year on year. And that was from a low in 2022.
Glenn, what has all this meant for your business on Redfin?
It's been a wild ride. So sales volume is around 4.1 million units, and we've had to make adjustments just because we employ our real estate agents, and that means that we have to keep them busy. So we went through a couple of layoffs at the end of last year. We're doing better now. We expect share to increase in the second half of this year, but it's been very disruptive. And yet, we still believe there's just a better way to buy or sell a home, that you could sell it for 1%, that you can get better service, that you can click a button to see into a property, to go tour it. So all of those things are still true. It's just hard to be a publicly traded company when you're in a very cyclical, seasonal business. We're going to see it through, though.
Glenn, when it comes to those people who are still out there looking for homes, they're still maybe among the buyers that are able to afford this. What's the demographic there? What are you seeing in terms of the people that are able to afford and where they're buying?
Well, some of them are Nepo home buyers, people who are borrowing money from mom and dad. So traditionally, America has had more class mobility than anyone else just because we've had more land. People have been able to buy into the American dream with a very small down payment. But because we tightened credit after the great financial crisis, and now we've got rates where they are, the only people who can buy a home often are the people with cash in hand. And that either means older people or children of wealthy people. So we're just seeing an increase in cash buyers and a decrease in everyone else who has to get financing.
What about for developers? I mean, are you seeing, sort of investors kind of pull out of the market because the upside isn't as significant, the inventory or the opportunities just aren't there? What are you seeing on that front?
Well, it's a tale of two investors. So the home builders are doing really well. A third of new listings are new construction listings because traditional listings that are coming from people who own a home just aren't on the market. People have decided to stay off the market because they want to keep that 3% mortgage. And so the builders have really got a monopoly on the attractive inventory, and more people than ever are buying new construction as a result. But if you're talking about investors who are Airbnb investors, where they're buying a home and flipping it, for the first time, we've seen them come under some duress. If you go to these really bubbly markets like a Boise or an Austin, they haven't been able to get the rent. They're trying to sell the property, and sometimes they're bringing cash to the closing table. Mostly, we haven't seen the kind of distress that marked 2008, which created all this inventory when no one else wanted to sell, foreclosure, short sales, and all the rest. But the investors who are trying to make a mint by creating an Airbnb empire are, in some places, just a few, starting to get upside down.
Glenn, going back to what you said earlier, when we talk about the tight inventory, obviously pushing prices higher, how much higher, I guess, how much longer do you see this trend staying intact?
Well, you tell me, when is the Federal Reserve going to lower rates? I know that the employment numbers eased a little bit, but mostly it's really a tale of two economies, too, that the rest of the economy is doing really well, which means that the housing economy isn't likely to catch a break by the end of 2023. Rates are going to stay around 7% or higher for the rest of the year, as far as we can tell. And I think until we get some rate relief, we're not going to see more inventory because people are going to want to hold on to their loans. And we're not going to see that much demand because so many people just can't afford the mortgage payment. So it's going to be a holding pattern at least through the rest of this year and probably into 24.
Extremely challenging time here for the housing market. Glenn Kelman, always great to have you, CEO of Redfin. Thanks. Have a good weekend.
Thanks for having me. Have a good weekend.
It is closing time here on Yahoo Finance. First up, the latest jobs report showing the labor market slowing. Unemployment jumped in August, up 0.3% to 3.8%. That is the highest level since February. And wage gains also moderated, a sign that inflation pressures are easing. Hiring remains steady with 187,000 jobs added. And the CEO of Walgreens has stepped down. Roz Brewer leaving the retailer after less than 3 years on the job. Ginger Graham, the current lead independent director at Walgreens, has been appointed interim CEO. And a search process to identify a permanent CEO is now underway. Gas prices heading into the holiday weekend are about 1 cent lower than last year. Tracker Gas Buddy predicts they'll fall further this weekend, but there may be, quote, one last hurrah at the pump before the fall. And finally, more than a 3-year pause on student loan payments is coming to an end. Interest on loans start accruing again today, and monthly payments will start up again in October.
Now here's a look at what to watch for next week. It is the unofficial end of summer with Labor Day on Monday. Markets are closed, so it will be a holiday-shortened week on Wall Street. It will also be a light week on the economic calendar. On Tuesday, we will get the latest reading on factory orders. And on Wednesday, we'll get data on the services sector, the trade deficit, and the Fed's beige book. Thursday, we will get the weekly look at jobless claims. And it's also a very busy day for Fed speak. Austin Goolsbee, Patrick Harker, Lori Logan, Raphael Bostic, and John Williams are all scheduled for speeches that day. And on the earnings front, meme stocks are in focus. GameStop and C3 AI are due to report. Tech will also be a focus all next week as Goldman Sachs hosts its Communacopia and Technology Conference. It's one of the largest investment banking conferences, and Yahoo Finance will be there. Executive editor Brian Sazi will get the pulse on the economy from top CEOs and how they are using artificial intelligence to take their businesses to that next level. That'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here Tuesday afternoon, 3 p.m. Eastern Time. Enjoy the holiday weekend.